You might have a person managing your Airbnb, but since there's more things being done throughout the year for different renters throughout the year, you are now a active investor. Where in the tax code, if you're an active investor with real estate, that means all of your expenses, you get to write that off towards your rental income and your W-2 or business income. Meaning, same scenario. I'm a W-2 employee. I make $100,000 a year. I got rental income that's 20,000. But now I'm writing off everything with my Airbnb, and my expenses are 40,000. Well, guess what? Since I'm an active employee, I don't write off just $20,000, which is how much I make as a income for my Airbnb. I get to write off all 40,000 towards my $20,000 of Airbnb income and my $100,000 of W-2 income. That's 20,000 more dollars of write-offs. $20,000 of write-offs in the 40% tax bracket is $8,000 that the IRS is giving to you every single year. If you're in the 22% tax bracket, that's $2,500 every year that the IRS is giving you for doing an Airbnb. So you see people on YouTube and social media talk about why to do Airbnbs. That's the best reason why. Airbnbs are more headaches, right? But from a tax standpoint, the IRS gives you more money by doing an Airbnb compared to a long-term rental. So I hope that kind of helps why, but anybody and everybody, if you have rental, even if it's one Airbnb, right? I would say as you build your rental portfolio, at least have one be an Airbnb because you get way more write-offs, and you also need to do a cost segregation study, which I'll talk about some different time because I'm running out of time here. All this game I'm giving y'all, man, all this game. So then your mortgage plus your expenses equals $2,000, which means you net $8,400 in annual profit. So that is a net. So you are building generational wealth because you have that property and it's going to grow over time for your child or your grandchild. You have cash flow coming in as well, and you're teaching them a life lesson because they're basically a RN, which is great. So step number 3, how do we funnel the profits through the trust to make sure Uncle Sam don't come knocking on our door? Well, the LLC collects the rental income and passes through the trust. Because remember, again, everything passes through the trust. The LLC, right? So the LLC passes through the trust. The trust pays the taxes. You can have the LLC pay the taxes or have the trust do it. The trust pays the taxes, but it can take deductions like depreciation, maintenance, and property management. It's yours. It's room and board where the university gets all that depreciation, all those write-offs. You do because it's yours. So you reduce your taxable trust income with those deductions. All about finding ways to make money and also save money as well. And then when they graduates, then we transfer on. So when your child or your grandchild graduates, we then just assign ownership of the property through the trust. And when you assign through, because the revocable trust, you get to make changes. So when you assign property through the trust, guess what happens? It passes to them, and they don't pay any gift taxes, and they don't pay any capital gains taxes. That is how we structure generational wealth. That is how we help our children and our grandchildren with their education. That's how we put money in our pocket at the same time. Or if you just want them to keep on getting the money, have cash flow, then you allow them to continue receiving the money from it through the trust if they don't own it. And again, with that money, you can just funnel it through a Roth IRA, have that money now grow tax-free, or you can do a traditional IRA because you're probably hiring them through your business. So you can do a traditional IRA or a SEP IRA, and now that money is funneling, and you get to write off 2 times because you're paying them a salary if they're in college, which I would strongly recommend, get the write-off. But then now if you put it into a traditional IRA or a SEP IRA, you as a business owner get to write that off as well. So it's 2 write-offs. IRS is giving you money to give money to your kids. And also, this protects from lawsuits, divorce, etc. We always recommend when we do a trust, especially we give the money to our children, we always want to put into the trust that when they receive the money, it can only go into their account, meaning that they can't commingle it with a friend, a spouse, because especially like in the state of Florida, 10 years, everything is even. So if I got money that's coming in all these years in my joint account, and your son and daughter gets divorced, then all that money that came in from you guys, the spouse that's divorcing is entitled to that, right? So it's always good to put into the trust where when they receive that money, the money that they receive has to just be in their account. It can't be commingled. Very, very, very important. Um, so yeah, so so Ty, a great point. Check out the county or city to verify if there are any restrictions on short-term rentals. So I know, like in New York, I'm in Florida, but I know the city of New York, they frown upon Airbnbs because hotel lobby losing all that money. So yes, some cities definitely have some restrictions on Airbnbs. So you definitely want to check that out. So that is a great point, Ty. All cities allow you to do short-term rentals. But most cities do allow you to, though, right? So yeah. But again, I'm not saying if you want to, you can. But I'm not saying every single property you have should be Airbnb because that's a headache. Even if you have a property management company, that's a headache. But if you have 4 or 5 rental, if you want to grow your rental, uh, empire per se, at least have one so that the IRS can pay you more money. And that's the name of the game. If we could do the same thing we're doing now and have the IRS pay us for it, we want to take advantage of that. All right, cool. And then again, bonus step up in basis. So again, if you pass away, as we talk about why you should do a trust, right? If it's anything else from this, why we should have us or our clients, if you're a business owner, do a trust. If you pass away, the trust holds the property. We have step up basis. So we pass away, the trust has the property, not you as a person. So your heirs, they get a step up basis and market value as they bought it. So they could then sell it and pay little or no capital gains taxes. Use the same example, right? Or let's say parents. My parents bought the house for 100,000. They die. The house is worth 200,000. I sell the house is now worth 250,000. If I don't have a trust, when I sell the house, I sell the house as if I bought it for $100,000 because that's when they bought it. So 100,000, I sell it for 250. I have to pay taxes on $150,000. Or if I had it through a trust, I then sell it as if I bought it when they died. So when they died, it was worth 200,000. I sold it when it was worth 250. I only pay taxes on $50,000. So that alone, $100,000, that's a $25,000 difference. That example by itself, that saves the client 20 right then and there. That doesn't include probate costs associated with passing down without a trust. Doesn't include the headaches of dealing with an attorney to get it out of probate. All that extra stuff that you can't put a price on, and you got to put a price on. Doesn't include that. Just the tax alone. So again, everybody should have a trust for that reason by itself. And also, every single person should have their clients do a trust for just that reason by itself. If I have a lot of write-offs in my Schedule C, which is me, being a small business owner of my own business, affect my buying power credit-wide. Credit's a little bit different. Credit is based on our FICO score. And so I'm just gonna real quick. People who've been on this call before, y'all know how to love credit cards. Y'all should have at least 5 credit cards. At least 5 credit cards. The reason why, because we have utilization rate. If we have more than 30% of spending power on our credit card, we are being affected negative way. Meaning, I got a $10,000 card I could do up to $10,000. If I charge more than $3,000, utilization rate is over 30%, dinged. Even if I charge $5,000 and I pay it off at the end of the month, I still get dinged because it's more than 30%. So you just spread out your credit cards. Don't have just one credit card, have 4 or 5 and put small amounts on each one. Now, from a FICO standpoint, the 2 biggest things that they look at is your utilization rate and your payment history. So I recommend everybody put everything on a credit card, and every single Friday, pay that credit card off. You're doing 2 things, and you are boosting your FICO score by 2 to 4 points every single time you do that. Number one, they look at your payment history. That's 35% of your FICO score. Out of 100%, 35% of your FICO score is your payment history. So if I'm paying something off every single Friday, that is positive, right? That looks good. Number 2, if my utilization rate is less than 30%, where I'm saying, hey, you give me all this money, but I don't use all this money on each card. That helps you as well. So that affects your credit score. You having, from an income standpoint, all these write-offs, it doesn't hurt you, because when you do a loan, when that banker or that mortgage person looks at it, they see all the income. So they see the income, right? So they see you're bringing in the money, but then they also see what you are doing as well, right? Oh, I did the Augusta rule. I paid my child, right? So they see you bringing in the money. They also see that you're being very strategic on how you are getting your write-offs. They might say, "Hey, who's your tax person?" That actually happened. One of my clients is a mortgage broker now. He became a mortgage broker because he was doing taxes. He was looking at doing a mortgage for my client, and kind of saw some of the things that we did. The Augusta rule in particular, he's like, "Man, my person don't do the Augusta rule, and I got my own. Like, who does your taxes?" And then the rest is history. Clive, Clive from California, he's not on here, but he's a client because of that. So I was rambling right there, but I hope that answered your question. Is it a good idea to do joint credit cards with the spouse to achieve the five? So the key, when you say achieve the five, what do you mean? As far as joint credit cards, yes. I mean, a joint credit card, to help build each other's credit is good. If one person has worse credit than another person, then you might want to think about putting the person that doesn't have as good as credit as an authorized user, right? Because if they're an authorized user, then when you do the card, you might get a better interest rate, or you might get 0% for a longer period of time, or you might get a larger credit limit, right? And then, of course, if they're authorized you, if you're doing the things I'm talking about, low utilization rate, paying it off every single Friday to boost your payment history, it's going to boost their credit score quicker. So that might be something to think about from a credit card standpoint. Oh, the 5 credit cards. So why does this work? This works because it avoids probate, because the trust avoids probate, no probate. That's money and time that you get back, and you can't put a price on that. Depreciation offsets with rental income, active versus passive. Like I said, being an active person who does rental with one Airbnb, if you're passive, you still get write-offs as a passive, which is long-term rentals, but not as much. So just think about that. Your child lives rent-free, right? Rent-free, which is always good. Income pays expenses and it builds legacy, like we talked about. You could transfer to a child with minimal or no taxation at all. And family wealth. I know somebody said that they're doing investment properties this weekend, looking to build wealth, and that's great. You're doing that. You're building wealth. We all should strive to put our children in a better position. All right. So last thing,